Chapter 6. Government Finances and Budgeting. Government budgeting is a planned act of allocation and distribution of the nation's resources for the development and growth of the nation as a whole. The government raises money from the economy to enable it to spend that in accordance with national priorities. These priorities are defined and targeted in the annual financial statement, popularly known as budget, which is presented annually in the Parliament. Fiscal policy. The fiscal policy is defined as the policy by which a government adjusts its spending levels and tax rates to monitor and influence a nation's economy. The fiscal policy is a macroeconomic tool used by government in public finance management. It is pursued to affect either the manner in which government raises resources or spends in accordance with requirements and national priorities. Thus, fiscal policy is framed to generate revenue, primarily through taxation, and incur expenditure, public expenditure, to influence aggregate demand and overall economic activity. Objectives of fiscal policy in India. The fiscal policy is framed to achieve the following objectives: to ensure rapid economic growth and development via efficient mobilization and allocation of resources. Taxation and expenditure must aim at reducing income inequalities and poverty in society. Black circle resources being raised must not create additional burden on common man. Expenditure being incurred should be able to control inflation and stabilize price. To increase employment through appropriate investment and incentives in the priority sector. To ensure a balanced regional development by promoting projects in backward areas. To encourage more exports by way of fiscal measures like export subsidies, tax holidays, etc. To increase the rate of capital formation and encourage savings. Government Finances and Budgeting. 53. The aforesaid objectives are being achieved by the annual financial statement, popularly known as budget, which is presented by the central government in Parliament. The successful achievement of these objectives depend on timely intervention and effective administration during implementation of budget. Public expenditure. Public expenditure pertains to spending by central and state governments. It is incurred on numerous activities for the well-being of the people and also for creating conducive environment for the economic advancement of the nation. Public expenditure can act as a tool for robust economic development in the following ways. Public expenditure should lead to creation of assets and increase in productivity. It must be approved by a legitimate authority before it is incurred. Auditing must be undertaken to establish propriety and minimize wastage. Public expenditure must promote flexibility in the nature of spending of the state. Classification of public expenditure in India. It is systematic arrangement of various expenditure items under different heads. 1. Capital expenditure represents the creation of assets in an economy, which leads to raster growth and development, e.g. money spent on infrastructure development. They are usually in terms of one-time investment. Capital expenditure can also be referred to as development expenditure, since it improves the NER productive capacity. 1. Revenue expenditures are recurring in nature and meant for consumption purposes as no assets are created, e.g. expenditure on administration in government machinery, maintenance, law and order, etc. See Rangarajan Committee on Efficient Management of Public Expenditure. A committee under the head of former PMEAC, Economic Advisory Council to the Prime Minister, Chairperson Mr. Rangarajan gave recommendations on efficient management of public expenditure. Its main recommendations are: the distinction between PLAR and non-PLAR expenditure be abolished for COTS, the center and the states. All public expenditure should be split up between capital and revenue expenditure. The revenue deficit should be ISTER to the extent of grants for creating assets out. Compliance. Only for fiscal response till tie badges management the budgetary plan allocation would be the responsability of the France Ministry. He Ministry of Finance may be responsible for guising the fiscal policy, prepare John of the Bedger and financial decisions. The Finance Ministry should be responsible for preparation of the annual budget, based on inputs of the scrapping of planned and non-planned expenditure and budget. With the government moving away iron the system of 5-year plans from the year 2017-18, the distinction between plan and non-plan was scrapped with implementation of new budget in 2017. The practice of classifying expenditure budget as plan and non-plan in the budget documents was introduced from the first 5-year plan in 1951, with the Planning Commission deciding the estimates of plan allocation. Plan expenditure included spending incurred on programs and schemes of the government detailed under the prevailing 5-year plan and included all kinds of expenditure on schemes, whether on recurring or revenue or capital heads. Non-plan expenditure is referred to outlays on routine functioning of the government like interest payments, subsidies, salary and pension payments, for regular cadre staff across sectors, police and defense, expenditure on maintenance of assets or infrastructure across sectors. There were issues related to accounting of expenditure classified as plan and non-plan. This classification had given rise to a misleading notion that plan expenditure was developmental and non-plan was non-developmental. The bias for plan over non-plan had gained wide acceptance. '54. General Studies, Mains, Paper I. And required correction. This notion led to an excessive focus on plan expenditures, with a corresponding neglect of items such as maintenance that was classified as non-plan. This was a part of Rangarajan Committee recommendations. Since the Planning Commission had been done away with, there was no requirement of planned and non-planned expenditure anymore, and a better indicator of productive and general expenditure will be a distinction under the heads of revenue and capital. Public revenue. Revenue comprises of receipts raised by the government through various sources to meet its expenditure. These receipts could be revenue or capital receipts. Revenue receipts are raised year-on-year basis as against capital receipts, which are lump sum amount raised in one go. Revenue receipts. Revenue receipts are characterized by their short-term nature and regularity. These do not include borrowings of government and thus do not create any interest liability. Public revenue consists of government taxes, dividends received from public sector enterprises, interest payment by state governments, revenue from administrative activities like fines, fees, etc. Revenue receipts are divided into two groups. Tax revenue. The primary source of revenue receipts is tax revenue, 84%. Tax is a compulsory payment by the citizens to the government to meet the public expenditure. It is legally imposed by the government on the taxpayer, and in no case taxpayer can deny to pay taxes to the government. Taxes could be either direct or indirect. 1. Direct tax. It is a tax where the subject on which the tax is levied is identifiable. The concerned person has to pay the tax and the tax burden cannot be shifted. It includes income tax, corporate tax, wealth tax, etc. They are mostly progressive in nature as tax increases with increase in income. This helps in reducing income inequalities and brings a more adequate social and economic justice. Other benefits of direct taxes include certainty, elasticity, economical and convenient to collect, and anti-inflationary. On the other hand, if the subject is unidentifiable or ill, the tax burden can be shifted. It is termed as indirect tax. Indirect tax. They are regressive in the sense that tax burden is higher on the people with lower income, since they are applied on commodities which are universally consumed by individuals irrespective of their income. Common examples are excise duty, payable on manufacturing activities, customs duty, duty on import or export of goods, service tax, etc. Characteristics of a tax. Characteristics of a tax are as follows. Tax is a compulsory payment imposed by the government. Refusal to pay tax is a punishable offense. Black circle tax is imposed on incomes or commodities. There is no quid pro quo between a taxpayer and public authorities. This means that the taxpayer cannot claim any specific benefit in return for the payment of a tax. A tax is levied to meet public spending incurred by the government in the general interest of the nation, and a tax is payable regularly and periodically as determined by the taxing authority. Non-tax revenue. The revenue obtained by the government from sources other than tax is called non-tax revenue. The main sources of non-tax revenue are as follows. Administrative revenues in terms of fees, fines, and penalties. Profits and dividends received from public sector enterprises. Black circle payment of interest by the state governments. Capital receipts. They are government receipts that create liabilities or reduce financial assets. Capital receipts can be both non-debt and debt receipts. Loans from the general public, foreign investments, and RBI form a crucial part of capital receipts besides proceeds from disinvestment. They are further divided into non-debt and debt receipts. Government finances and budgeting. 55. Non-debt capital receipts. These receipts do not incur any future repayment burden for the government. recovery of loans and advances, disinvestment, issue of bonus share, etc. are examples of non-debt capital receipts. Debt capital receipts. These receipts have to be repaid by the government. Around 25% of government expenditure is financed through borrowing. As they involve regular interest payment, reduction in debt receipt can be a big leap for the economy's financial health. Examples of debt capital receipts includes treasury bills, short-term borrowings, state provident funds, gold, bonds, external debts, etc. Government budget. Capital budget. Revenue receipts. Revenue expenditure. Non-tax revenue. Capital receipts. Expenditure. Tax revenue. Taxation. Taxes are the main source of government revenues and thus associated with the fiscal policy. Methods of taxation. The methods of taxation are as follows. Progressive taxation. It is a tax in which the tax rate increases as the tax base increases. Here the rate of taxation increases as the income increases. A progressive tax takes a larger percentage of income in taxes from the high-income group than it does from the low-income group. Progressive taxes reduce the incidence of taxes on people with lower incomes. Thus, people with lower incomes actually pay less and those with higher incomes pay more. In case of progressive taxes, the average tax rate is less than the marginal tax rate. Regressive taxation. Regressive means going from high to low. It is a tax imposed in such a manner that the tax rate decreases as the amount of taxable income increases. The higher income group pays less in taxes than the lower income group. Regressive taxes impose greater tax burden on the poor relative to the rich. People with low income and low ability to pay will pay higher taxes. This means that it hits lower income individuals harder. In case of regressive taxes, the average tax rate exceeds the marginal tax rate. A value-added tax or sales tax on food, clothing, and transportation can be regressive. Since each person pays the same amount of money, it is a lower proportion for people with higher incomes. Proportional taxation. It is a tax where the rate of taxation is fixed, as 10% or 15% or 25%. The amount of the tax is a fixed proportion of one's income. It stays a fixed percentage of one's income, irrespective of how high or low the income is. Proportional taxes charge the same percentage of income as taxes from all taxpayers, regardless of their income. A proportional tax applies the same tax rate across low, middle, and high-income taxpayers. The rate of taxation does not change as income changes. In case of proportional taxes, the marginal tax rate is equal to the average tax rate. In case of proportional taxes, the incidence of taxes is equal, regardless of one's ability to pay. Proportional taxes are also called flat tax. It may also encourage people to earn more since they do not have to pay at a higher tax rate. A sales tax is a type of proportional tax since all consumers, regardless of earnings, are required to pay the same. Fixed rate. Tax reforms in India. The government has initiated a major overhaul of taxation system by undertaking reforms in direct and indirect taxes in terms of introducing direct taxes code, DTC, and goods and services taxes, GST, respectively. The aim is to simplify the tax structure, widen the tax base and enforce compliance so as to significantly increase tax GDP ratio. Direct Tax Code. The Income Tax Act, 1961, which governs direct taxation in India, was drafted as per the structure of the economy prevalent in 1960s. The last 6 decades. '56. General Studies, Mains, Paper 3. Saw the liberalization and privatization of Indian economy. Further new models of doing business such as e-commerce has emerged. The judgments of the courts or amendments by Parliament has made the act cumbersome with over 700 sections. Successive governments since 2009 have passed various draft legislation and discussion paper on direct tax code in India. In this regard, a task force headed by Akhilesh Ranjan has submitted draft legislation of the new direct tax code in August 2019. Key features of the draft direct tax code are a common corporate tax with slab rate of 25% for both large local as well as foreign companies that are present in India without subsidiary. Similar to DTC 2013, in new proposed legislation, foreign companies will have to sell out branch profit tax on the amount repatriated to their foreign headquarters, in addition to the corporate tax. It incentives the startups by treating them differently subsequent stages. From that of normal company funds raised by the startups will not require any kind of scrutiny. A separate litigation management unit is proposed to establish and manage tax litigation process, right from deciding in which cases the appeals ought to be filed, to devising the strategy to defend the case. It introduced a new concept of settlement through mediation. Taxpayers will be able to opt for a negotiated settlement before a collegium of commissioners. Black Circle. It also proposes the removal of surcharge and cesses which are currently imposed above a certain income slab. It favors jurisdiction-free, anonymous assessment by domain experts with the involvement of senior officials. For this, an assessment unit as well as a separate litigation unit will be created to replace an assessing officer. Direct Tax Vivad Se Vishwas Act, 2020. Parliament passed this act to settle tax disputes related to direct taxation which have been pending with commissioners of income tax appellate tribunal as well as with High Court or Supreme Court. S.C.N.T.S. It provides an opportunity to taxpayers to settle the tax disputes by paying due taxes with complete waiver of interest and penalty till June 30th. The act expected to resolve 90% of 4.83 lakh direct tax cases worth 79.32 lakh crore that are currently locked in various appellate forums. Goods and Services Tax, GST. India's biggest tax reform since independence, Goods and Service Tax, GST, came into force from the midnight of 1st July, 2017 after nearly 17 years of debate, discussion and dissent. GST, most of the time termed as One Nation, One Indirect Tax, means it is a single tax on the supply of goods and service right from the manufacturer to the consumer. The highlight of Goods and Service Tax are as follows. It is a destination-based tax unlike the previous taxation scheme which is origin-based. It is a value-based tax as credits of input taxes paid at each stage will be available in the right pointing arrow. The final consumer will bear only the GST charged by the last dealer in the supply chain. Central taxes being subsumed under GST. Central excise duty * additional excise duty. Service tax. Additional custom duty or countervailing duty. Black Circle Special Additional Duty of Customs State-Level Taxes, subsumed under GST. Black Circle Sales VAT or Sales Tax. Entertainment Tax, other than tax levied by local bodies. Central Sales Tax, that is levied by center and collected by states. Black Circle Octroi and Entry Tax Purchase Tax. Black Circle Luxury Tax. Black Circle Taxes on Lottery, Betting and Gambling. GST Council. The members of GST Council are as follows: Black Circle Union Finance Minister, Chairperson. The Union Minister of State, in charge of Revenue of Finance, Member. The Minister in charge of Finance or Taxation or any other minister nominated by each state government, Members. Government Finances and Budgeting. 57. Benefit of GST. The new taxation regime will be easier to administer for the government because the input tax credit system creates a mechanism for self-policing, tax competition and cooperation between center and states due to dual monitoring. The probability of tax evasion is very low due to better control on loopholes. Higher revenue efficiency of the government and more money to spend on welfare expenditure. GST will give major boost to the Make in India initiative of government by making goods and services produced in India competitive in national as well as international market. For customers, consumers, the benefits are no cascading burden of taxes which would moderate inflation. More transparency in taxation regime and easier to understand for customers. The taxpayer would not be required to maintain records and show compliance with a myriad of indirect tax laws of the central government and state. For example, the central excise, service tax, octroi entry tax, etc. Anti-Profiteering Authority. The National Anti-Profiteering Authority, NAA, has been constituted under Section 171 of the Central Goods and Services Tax Act, 2017. It is to ensure the reduction in rate of tax or the benefit of input tax credit is passed on to the recipient by way of commensurate reduction in prices. The institutional mechanism under GST law is to check the unfair profit-making activities by the trading community. The authority's core function is to ensure that the benefits of the reduction in GST rates on goods and services made by GST Council and proportional change in the input tax credit passed on to the ultimate consumers and recipient respectively by way of reduction in the prices by the suppliers. This institutional framework comprises the NAA, a standing committee, screening committees in every state and the Directorate General of Safeguards in the Central Board of Excise and Customs, CBEC. NAA has taken the following steps for customers to get the full benefit of tax cuts: holding regular meetings with the zonal screening committees and the chief commissioners of central tax to stress upon consumer awareness programs. Launching a helpline to resolve the queries of citizens regarding registration of complaints against profiteering. Receiving complaints through email and NAA portal. Black Circle working with consumer welfare organizations to facilitate outreach activities. Black Circle a number of complaints regarding companies not passing on the full benefits of tax cuts to consumers have been received by the National Anti-Profiteering Authority, NAA. Tax to GDP ratio. It is representation of the size of the government's tax revenue expressed as a percentage of the GDP. A higher tax to GDP ratio means that the government is able to cast its fiscal net wide. It reduces a government's dependence on borrowings. Although India has improved its tax to GDP ratio in the last 6 years, it is still far lower than the average OECD ratio, which is 34%. The tax to GDP ratio for the country in 2019 was 10.9%. Reasons for India's low tax to GDP ratio. Following reasons can be attributed to the low tax, both direct and indirect, to GDP ratio in India. 1. High tax evasions. Tax compliance in India is extremely low. Low per capita income. Low average incomes and a high poverty rate result in a very small portion of the labor force being eligible to pay personnel income tax. Unorganized sector. India has relatively large informal unorganized sector, and tax evasion is more rampant in informal sector compared to organized sector. Small tax base and its adverse effect. Tax buoyancy in India, only 3% people pay income tax. This is because a large population is still poor and hence don't earn enough to be in taxable income bracket, but also because even those who fall under the tax bracket either don't pay or pay very little taxes. '58. General Studies, Mains, Paper 3. A small tax base unnecessary burdens the honest taxpayer. According to Shom Panel, in the last 10 years, though the direct tax collection has increased by more than 700%, the number of taxpayers has merely grown by 35%. Lingering of contentious, adversarial tax issues. India has one of highest number of disputes between tax administration and taxpayers, with lowest proportion of recovery of tax arrears, e.g. the Vodafone lakhs dispute involving 20k crore lingering since 2008. Tax exemption and subsidy policies. The exemptions in the taxable income have grown at a much faster rate than the income. As a result, there is less tax buoyancy. Similarly, tax expenditure in the form of tax subsidies and exemptions was more than 76 lakh crore in 2015-16. Loopholes in double tax avoidance treaties. Provisions for tax exemptions from short-term capital gains are often misused by companies to reroute their investments from such countries, all round-tripping of funds. Similarly, issues related to tax evasion, double non-taxation and transfer pricing need to be fixed. Flourishing informal market ecosystem. Informal sectors like paying guest accommodations, kirana stores, stationery shops, etc. evade taxation. Measures to improve tax to GDP ratio. Widening tax base. This can be done by implementing GST. It will be a game changer to radically improve collection efficiency, will phase out a number of exemptions in a phased manner, lower tax rates, increase the compliance level and generate more revenues from indirect taxes. GST will widen the tax base and generate additional revenues. Improving compliance rate of tax laws. GAR, General Anti-Avoidance Rules, provisions may be useful in dealing with tax evasions where tax benefits exceed certain limit. Efficient targeting of subsidies and phasing out of tax exemption. Subsidies to the well-off need to be scaled back, similarly TA exemptions to be reviewed and phased out. Reasonable taxation of the better off regardless of where they get their income from, like industry, services, real estate, or agriculture. IV. Fast tracking of disputes. Fast tracking of tax disputes. Reducing discretion of taxman in creating a predictable dispute resolution mechanism will augment tax to GDP ratio in India. Tax buoyancy. A tax is buoyant when revenues increase by more than 1% for a 7% increase in GDP. After the Fiscal Responsibility and Budget Management (FRBM) Act, direct and indirect taxes remained buoyant except in the crisis years, 2008-09 and 2009-10, but in 2011-12, the tax buoyancy declined sharply in corporate tax sector due to high level of inflation, which decreased the actual profits of corporate sector. Finance Commission. It is a constitutional body. Finance Commission Act, 1951, Article 280 speaks about the provision of formation of the Finance Commission by the President. The article says that Finance Commission is established for the purpose of allocation of certain resources of revenue between the Union and the state governments. 14th Finance Commission. As mandated by the Article 280 of the Constitution, the government has constituted the 14th Finance Commission under the chairmanship of Dr. Y.V. Reddy, former RBI governor. The report covers a period of 5 years commencing on the 1st of April 2015. The Commission submitted its report in December 2014. Highlights of 14th Finance Commission Report. Highlights of 14th Finance Commission Report are as follows. Black Circle States' share in the net proceeds of union tax revenues increased to 42% from 32% earlier. This is the largest ever jump in percentage of devolution. Government finances and budgeting. 59. 8 centrally sponsored schemes, CSS, delinked from support from the center. Finance Commission has identified over 30 CSS schemes to be delinked from center's support, but all have not yet been delinked considering the national priorities and legal obligations. Sharing pattern under various CSS to undergo a change, with states sharing higher fiscal responsibility for scheme implementation. This is due to higher devolution of tax proceeds. Distribution of grants to states for local bodies based on 2011 population data, 90% weight, and area, 10% weight. Black Circle revenue compensation to states under GST should be for 5 years, 100% in first 3 years, 75% in fourth year and 50% in fifth year. Create an autonomous and independent GST compensation fund through legislative actions to facilitate the compensation process. Suggesting a fiscal consolidation roadmap, FFC puts a ceiling on fiscal deficit at 3% of GDP from 2016-17 onwards. Some flexible provisions for states' borrowings over and above the annual limit of fiscal deficit at 3% of GSDP. 15th Finance Commission. The 15th Finance Commission was constituted by a presidential order in November 2017 under the chairmanship of N.K. Singh, former Member of Parliament and former Secretary to the Government of India, to decide the formula for devolution of revenue between center and states. The 15th Finance Commission is required to submit 2 reports. The first report will consist of recommendations for the financial years 2020-21. The final report with recommendations for the 2021 to 26 period will be submitted by the 30th of October 2020. Recommendations for 2020-21 key recommendations in the first report, 2020-21 period. The share of states in the center's tax is recommended to be decreased from 42% to 41% for 2020-21 to provide for resource to newly formed union territories of Jammu and Kashmir and Ladakh. Black Circle. It relied on income, distance, population, 2011 census, geographical area and forest cover in addition to demographic performance and tax effort to determine each state's share in central taxes. The states will be provided with revenue deficit grants, grants to local bodies and disaster management grants. In addition to grant of 7,375 crore for nutrition in 2020-21. Term of reference for 2021 to 26. 15th Finance Commission has been mandated to use data from the 2011 census for fund transfer to states under the population-based criteria. Apart from this, other terms of references of 15th FC are as follows. Principles governing the vertical devolution of taxes between union and states. Principles governing the horizontal distribution between the states. Grant in aid to states supplements the resources of PRI, ULBS from states' consolidated funds. Performance-based incentives for states on parameters like efforts made in expansion of GST FaxNet, achieving replacement level of population growth (LA). Total fertility rate 2.1 or lower. Controlling the expenditure on populist measures and behavioral changes to end open defecation. Exclusive. GAR is an acronym for General Anti-Avoidance Rules, which are framed to minimize tax avoidance, e.g. by siphoning off profits to tax havens. Anti-avoidance rules are broadly divided into two categories, namely general and specific. Thus, legislation dealing with general rules are termed as GAR, whereas legislation dealing with specific avoidance are termed as SAR. To minimize the loss of tax to India in the form of tax avoidance, the Finance Act 2012 introduced the General Anti-Avoidance Rules in the Income Tax Act, 1961. GAR is a tool to deal with international taxation system. GAR is often confused with tax evasion. Both are conceptually different. Tax evasion arises where the taxpayer is fully aware that income has been derived, but he deliberately conceals this income for tax purposes. Tax avoidance, on the other hand, arises when a taxpayer gets into an arrangement that has the effect of creating a tax advantage that would not exist if the arrangement had not been created. General Studies, Mains, Paper 3. Implications on GAR. The implications of GAR are as follows. It empowers officials to deny the tax benefits on transactions or arrangements which do not have any commercial substance or consideration other than achieving tax benefit. It contains a provision allowing the government to retroactively tax overseas deals involving local assets, like Vodafone. It could also be used by the government to target participatory notes, P-notes. It is intended to target tax evaders, especially Indian companies and investors trying to route investments through Mauritius or other tax havens in order to avoid taxes. GAR provides discretionary powers to revenue authorities to tax impermissible avoidance arrangements. The arrangements as a whole or partly may be disregarded and tax benefit denied. When the first draft of the GAR was introduced, it created tension in the financial market. The draft was heavily criticized by the people, citing it will have adverse implications on foreign investments. So, it forced government to defer the introduction of GAR High 1 year to 2013 and approved for constitution of an expert committee headed by Dr. Parthasarathi Shome to study the provisions of GAR recommendations on GAR. Based on the recommendations of Shome Committee, the government notified the much diluted GAR provisions that came into effect from April 2017 and applied to business arrangements with a tax benefit exceeding *3 crore. All investments made by foreign investors prior to August 2010 will not attract the General Anti-Avoidance Rules or GAR. GAR would be applicable only to foreign institutional investors that have not taken the benefit of an agreement under Section 90 or Section 90A of the 1T Act or Double Taxation Avoidance Agreement, DTAA. It would also not apply to business arrangements where the tax benefit in the relevant assessment year arising, in aggregate, to all parties to the arrangement does not exceed a sum of 3 crore. Double Taxation Avoidance Agreement. It is a type of treaty signed between two or more countries and is applicable in cases where a taxpayer residing in one country has to earn his income from other country. It eliminates the international double taxation, promotes the exchange of goods, services and investment between the two countries. The mutually agreed tax rates and jurisdiction on specific kind of income arising in one country to a tax resident of another country. India has signed DTAA agreement with more than 90 countries. It will provide tax certainty to the various investors and businesses of both the countries through the clear allocation of taxing rights bet when the contracting states by the agreement foreign companies that are resident in the countries that India has ITAA with can claim more beneficial provision and rates between the IT Act and the DTAA. Digital taxation in India. As part of the measure to address the tax challenge posed by the increased digitalization of the economy, an equalization levy was introduced by the Finance Act, 2016, on certain non-resident businesses. The levy was applied at the rate of 6% on certain specified services such as online advertisement and any provision for digital advertising space. The e-commerce operator is defined as a non-resident that owns, operates or manages a digital or electronic facility or platform for online sales of good or online provision of the services. It is applicable when the goods or services are provided by the e-commerce operator to citizen as well as resident of India. Further, it will also be applicable to person whose IP address located in India. Finance Bill 2020 proposes to expand the scope of the equalization levy to include consideration received by e-commerce operators from e-commerce supplier services and taxed at the rate of 2%. For many large digital companies, India is the largest market in terms of user base, and experts have been saying that tech giants need to pay taxes according to the number of users they have in any jurisdictions. However, unlike the earlier levy on advertising, under the new regime, the foreign e-commerce operator will be required to make compliances in India, which could also raise potential challenges. Government finances and budgeting. 61. Public debt. Public debt refers to government debt in the form of borrowings from individual investor, financial market and foreign nations. These serve an important purpose of public expenditure as revenue collected through taxes and other sources falls short to meet the development and maintenance functions. Thus, budgetary deficit is usually covered through public debt. In short, public debt refers to obligations of governments, particularly those evidenced by securities, to pay sums to the holders at some future date. Government finances and budgeting. 61. Public debt. Public debt refers to government debt in the form of borrowings from individual investor, financial market and foreign nations. These serve an important purpose of public expenditure as revenue collected through taxes and other sources falls short to meet the development and maintenance functions. Thus, budgetary deficit is usually covered through public debt. In short, public debt refers to obligations of governments, particularly those evidenced by securities, to pay sums to the holders at some future date. Since financial crisis of 2007-08, public debt has grown at a very fast pace amid rising fiscal deficit. This has been an area of concern among policymakers as it weakens macroeconomic indicators, lowers credit rating of the country and adversely impacts the investment. Debt obligation of union government can be divided into internal, external and short-term, medium-term debt and long-term debt liabilities. Internal debt. The Government of India takes ways and means advances from RBI to meet its short-period expenditure as all the receipts come with a lag over a period of time while committed expenditure has to be incurred immediately. These are borrowings of government from within the nation. Public loans floated within the country are called internal debt. The various internal sources from which the government borrows include individuals, banks, business firms and others. The various instruments of internal debt include market loans, bonds, treasury bills, ways and means advances, etc. An internal debt may be either voluntary or compulsory. Internal debt implies a redistribution of income and wealth within the country and therefore it has no direct money burden. Internal debt, constituting 90.9% of public debt, largely consists of fixed tenure, fixed coupon dated securins, 72.1%, and treasury bills, 10.2%. State governments are not allowed to directly borrow externally, hence, their entire debt is domestic. External debt. Borrowing by the government from abroad is known as external debt. The external debt comprises multilateral borrowings, bilateral borrowings, loans from IMF and World Bank, Asian Development Bank, etc. External loans help to take up various developmental programs in developing and underdeveloped countries. These loans are usually voluntary in nature. Initially, an external loan involves a transfer of resources from foreign countries to domestic country, but when interest and principal amount are being repaid, a transfer of resources takes place in reverse direction. According to Global Development Finance Report 2009, India is ranked as 7th largest debtor country in the world. This is a huge burden. Short-term debt. Loans for a period of less than 1 year are known as short-term debt, e.g. The treasury bills are issued by RBI on behalf of the government to raise funds for a period of 91 days and 182 days. Interest rates on such loans are very low. To cover the temporary deficits in budget, short-term loans are taken. Medium-term debt. The period of medium-term debt is normally for a period above 1 year and up to 5 years. One of the main forms of medium-term debt is by way of market loans. The interest rates on medium-term loans are reasonable. These are preferred to meet expenditure on health, education, relief work, etc. Long-term debt. Loans for a period exceeding 5 years are called long-term debt. One of the main forms of long-term loans is by way of issue of bonds. Long-term debt is required for the purpose of retirement of debts and also for the purpose of development projects. (3262). General Studies, Mains, Paper 3. Problem of debt trap. Quite often, borrowed funds are utilized for non-development and unproductive purposes. Sometimes, highly indebted countries borrow funds to repay the earlier debts. Such heavy borrowings to repay earlier debts put highly indebted countries in external debt trap. Recent examples of 2010 crisis in which European nations such as Portugal, Italy, Spain and Ireland have gone through debt trap situation. Debt to GDP ratio. It indicates how likely the country can pay off its debt. Investors often look at the debt to GDP ratio to assess the government's ability to finance its debt. Higher debt to GDP ratios have fueled economic crisis worldwide. In 2019 financial year, India recorded a government debt equivalent to 69.62%. The N.K. Singh Committee on FRBM had envisaged a debt to GDP ratio of 40% for the central government and 20% for states, aiming for a total of 60% general government debt to GDP ratio. Public Debt Management Agency, PDMA. It was envisaged by the finance minister in 2015 budget speech. In 2016, an interim arrangement has been done by creating the Public Debt Management Cell within the RBI. This cell will eventually grow into Public Debt Management Agency. The main aim is to segregate the debt management function of the RBI and allotted it to independent agency besides effective management of public debt. Some of the functions as outlined by the government are as follows. To prepare plans for the government borrowing. To manage the liabilities of the government. To monitor the cash balance. To improve the forecasting of the cash. To advise the government on capital market operations, investment, administration of the rates of interest on small saving. To develop an integrated debt database system which shall act as a centralized database of all the liabilities of government on real-time basis. Base erosion and profit shifting, BEPS. Base erosion and profit shifting, BEPS, is a tax planning strategy that makes use of the gaps and mismatches in the tax rules of a particular country to shift profit to countries having low or non-tax policies through manipulation, resulting in little or no overall corporate tax being paid. It is a technique used by multinational companies to avoid paying taxes in a country by understating the taxable profile, thus ending up paying less taxes on the profit than it should have been, generally done by following three methods. 1. Transfer pricing. A transfer price is the price at which divisions of a company transact with each other. It is used when individual entities of a large multi-entity form are treated and measured as separately run entities. Vodafone selling shares of one of its subsidiaries, in India, to another subsidiary in Mauritius at below market price, India not getting any capital gains tax, later selling those shares to other at market prices, making windfall gain. Source country India and destination country UK. Netherlands don't get any laxes. 2. Special purpose vehicle. Creating a post box company in a tax haven country like Mauritius, e.g. Hutch SR, created in Mauritius, later sold to Vodafone and Hutch SR became Vodafone. India gets zero capital gains lax. Destination country gets nothing.